Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is April 29th, 2018 edition of Market Outlook. So certainly interesting times we live in. Peace may actually break out on the Korean Peninsula. That should be good for markets by taking the geopolitical risk off the table. Okay, so taking a look at U.S. indices, what's interesting is, as you can see, we're 3 out of the 4 indices we're in warning phases. That means that we're sitting beneath the 50-day moving average, but the 50 and is above the 200. So that's called a warning phase. And we've got that in the S&P. We have that in the Qs. Made a valiant attempt on Friday, gapping up on Amazon's earnings, but couldn't quite hold. You got a similar scenario in the Dow as well. Now, the other point to make here is IWM, which has been pretty much lagging, is the only one of the 4 key indices to be sitting above its 50-day moving average. Now, the other thing, it's also on a real motion or momentum basis, the strongest out of the 4 as well. So at the moment, 3 out of the 4 indices definitely under pressure, and real motion at the moment favoring IWM. Now, one other point I'd like to make is just how effective the the real motion indicators can operate. So one of the things you can see, we got a breakout over last week over the 50-day moving averages that promptly fell, broke the trend line off the low and penetrated the 50, and you got a pretty nasty sell-off. Now, notice our real motion indicator, even though we cleared that 50-day moving average, we weren't able to clear the real motion, the 50 and the 200-day, and in fact it was nicely contained by the 200-day of real motion. The same thing happened in the S&P and in the Dow. So one of the things I just want to say, if you're not familiar with our proprietary indicators, you can certainly call, and there's a whole program based on our real motion indicator. Now, another thing, let's take a look at the weekly charts. These are looking quite a bit better overall than the dailies. So one thing you can note is that you basically have overall pretty strong price action and momentum action, with the exception of a couple of things here. And that is, number one, you can see that we're trading under the 50-week and 200-week of real motion while holding the key 50-week on the price chart. So momentum is definitely breaking down on the S&P. Now, in the Dow, even though we're very, very weak on the daily charts, the weekly charts tell a different story. At the moment, right, on this move up, there was no divergence. So this sell-off is basically holding and working along with the price action. So you can't really read anything into it. And overall, with this rising 50-week moving average, that's pretty impressive until we really violate that. Now, you got a similar situation in IWM, and the only thing that's of concern, right, is this S&P, where it's basically trading under our real motion indicators, indicating potential breakdown here in the S&P, and of course that would trigger everything else. But that's only 1 out of the 4 indices. The other thing to note is, look, on the weekly charts in the NASDAQ 100, you had a high followed by this momentum high on our real motion and another high up here, but guess what? We weren't able to confirm that on our real motion. So you've got a somewhat of a divergence. Now that could be due to the FANG stocks. I did an extensive coverage of that this week in another product, and basically the FANG stocks look like they're about to really shift, where 2 out of the 4 are bearish looking, and only 2 are positive. So the jury's out as to what's going to happen with FANG, which could really determine what happens with the NASDAQ index, and that could definitely have a strong impact on the rest of the market. Looking at some of our key intermarket relationships, one thing to note is that the S&P now is underperforming utilities. That's generally a sign of a flight to safety and looking for some guaranteed income. So you can see here when this red penetrated the black line midweek here, that definitely put the S&P on the defensive in terms of this particular chart. Now, the other point to note is this is the first time in quite some time that we've been under our 6-month moving average of the ratio here between S&P and utilities. Now, that is important to note. So we had that one spike here, and then the market bounced back immediately, but it's really been some time since the S&P has been underperforming utilities, both on a short-term basis and a long-term basis. However, if we take a look at 4 other key ratios, things are looking pretty decent here. Number one, the S&P definitely has been able to overall sidestep the action in bonds. So one thing you have here, right, these are our four other key market relationships, and so versus bonds, we're in sort of good shape. The next one is looking at high yield debt. So even though it deteriorated a little bit over Friday's action, taking a look right now at high yield debt versus the safety of U.S. long bonds, high yield debt still outperforming nicely. That's a big positive. In terms of that S&P versus the bonds, you got a similar scenario as well, a big positive. Now, in terms of the S&P versus gold, we were a bit concerned that it was looking a little strenuous on the S&Ps here, and geopolitical risk, all different other types of pressures. We had gold outperforming the S&P. Now, on a monthly basis, that has definitely shifted over the last week to week and a half with the sell-off in gold and sort of the stabilized action in the S&P. And again, the other thing that's a positive here is wood versus gold. Obviously, a risk-off environment is a scenario where gold is outperforming wood. This is definitely showing inflationary pressures. So there you have it in terms of intermarket relationships. At the moment, 4 out of the 5 are indicating positive situation. Taking a look at volume analysis, things really have not improved very much. Remember, over the last couple of weeks we have been concerned we hadn't seen very many accumulation days. Well, we still have this scenario in play as well. Although one thing that has improved is we've eliminated some of the number of distribution days over the last several weeks. So you've sort of had action where there wasn't either an accumulation or a distribution day, so that dropped off. So the balance here, you can see there's no real buying that's coming in that's obvious, with the exception of NASDAQ, which basically picked up an accumulation day on Friday based on excellent earnings from Amazon that spilled over to the index overall. So net, volume is showing a negative situation, but it's slightly or marginally improving. And as you can see, the action this week pretty much flat. It's about the closest 1 week range of action that we've had in quite some time. So as you can see, the markets, the key indices here, year to date, are basically on average about flat year to date, with the Dow down the most and the Nasdaq 100 actually up 4% so far this year. Okay, now taking a look at sectors, what's interesting, over the last couple of weeks we've definitely deteriorated, and the number of sectors that are underperforming or down over the last 6 months has definitely picked up. I mean, as you can see, right now we've got 1, 2, 3, 4, 5, 6 sectors that have negative 6-month performance. That's pretty weak. We don't like to see it much more than 3 here, and at 6, it's definitely putting the market in a defensive mode. Now, what is also interesting is that this week, right, 4% move in retail. That's almost like people are buying up beat up retail stocks and taking advantage of that scenario, as opposed to buying things like semiconductors, which were actually down for the week. So the speculative sectors here definitely under pressure, right? Healthcare, biotech, these things actually worked in divergence. So at the moment, we don't have IBB in this particular group. It's included in XLV. But the healthcare, which has a lot of safety plays as well, basically moved up this week, and the IBB did not. So basically, the speculative sectors not really doing all that well. And as you can see, technology in general down on the week, semiconductors down as well. So those are your big speculative plays, and they're negative. And of course, the retail one is more like looking at value stocks. Okay, taking a look at this chart here, this looks at the a number of sectors. There's I think about 14, or let's see what we have here. Yeah, we have about 14, 15 sectors that we look at. And what this is, it basically tells you how many sectors are up over the last 6 months versus down. And again, this is definitely an interesting read on the market, because as you can see over here, right, once you start seeing a lot of red exceeding the -3 level here, you definitely get some pressure, right? You can see some pressure here. Now in this way, this move up here sort of violated that, but look, you got a bunch of sideways movement, and you can see you've had definite pressure here as well if you're looking at the number of sectors that are positive. We really, to see this type of blow off move up in here, we definitely like to see very few sectors down over the last 6 months. Not the case currently. So we improved a little bit over the last couple of days, but still not enough to put this in positive territory. So if you're looking at all the different things and adding sort of the composite view here, I would say sector participation definitely negative. Okay, so to sum things up, you can say trend, considering the weeklies, positive, the daily charts a little bit more of a negative, so I give that a minor positive. The 5 key intermarket relationships, I'm looking at that as a net overall positive. The bigger concerns here are volume. No institutional volume can be seen here in a meaningful way. So that is a negative. And the other thing is sector participation, definitely weakening here, and some of the weaker sectors outperforming, and the strongest, more speculative sectors are a bit weaker. So that puts us into a overall negative situation regarding sectors. So net net, you sum it all up, it looks like a pretty neutral environment. We're going to be a slave to the tape. And again, let's make sure we understand what we're talking about, because at this point, if you take a look at the charts here, the 200-day moving average, really critical support. And if we can take out the 50-day on the other three indices, we could have another run to the highs in the other indices, and then we'll have to take another look. All right, that's it for now. See you next week, and good luck with your trading.